Yo, what's up, everybody? It's Monday, October 10th. Today was the Columbus Day holiday here in the U.S., so the bond market was closed, stock market was open. Another ugly day, we were down. Folks, if you've been following me for any length of time, you know that way back, I've said there would come a day, one day, when because the Fed back in 2008, that's when Bernanke was Fed chair, and he asked Congress for authorization for the Fed to pay interest on reserves directly. Prior to that, for all the years before 2008, the U.S. Treasury paid interest on reserves. But Bernanke asked Congress to give the Fed that authority, because he said, well, it's going to help us to better manage our policy rate. And I said, because of that move, there's going to come a day when the Fed starts raising interest rates, and that obligation to pay interest on reserves is going to exceed, they're going to have to pay more than what they earn on their portfolio, on their holdings. And that day has come. I said it was going to come eventually when they start raising rates. And now it's finally starting to hit the news. I see, today it's been all over the news. Now, this is kind of inconsequential, at least in terms of its ability to conduct policy. But what's going to be interesting, and I said this in the past, is how's Congress going to react? Because at the end of every year, the Fed is required to remit its profits to the U.S. Treasury. And, it keeps whatever it needs to operate itself, but it has to give its profits over to the U.S. Treasury. And over the last few years, because of its huge balance sheet, $9 trillion, and it was paying like nothing, reserves, interest was like zero, right? 0 to 25 basis points. Now it's, it's all the way, it's going to be at 4%. Now it's like 3 to 325. Every year the Fed was handing over like 100 billion, 90 billion, 100 billion, 111 billion to the Treasury. Now there's no money to hand over. So I'm just wondering how Congress is going to deal with that, because once they get a whiff of that, there's going to be, how they are. They're going to be, the Fed's broke. The Fed's broke. So anyway, yeah, that's something that I said a long time ago. I said this was going to happen when they start raising rates. I said that back then, I said the threshold was, around 2.5%, 3%. And that's exactly where we are now. And, negative cash flow for the Fed. But again, it's not going to affect its ability to conduct policy. And they're still talking about a terminal policy rate of like 450 to 475 by sometime next year. And let's face it, I think that, this is still the big negative factor hanging over the stock market. And I'm wondering too, it's also probably, maybe to a growing extent, the escalation in the war in Ukraine. We had the Kerch bridge blown up, and I knew that was going to happen. I just knew that was going to happen. Russia went into this situation. Putin went into this like with kid gloves. It's war, man. You either got to win, or you go in, half-hearted like that, saying special military operation, we're just going to do a little here, a little there. And then Ukraine's getting supplied by NATO and the United States with all kinds of weapons. I knew it would end up to be bad news. And I just don't think the Russians have a capable military. And they're not going to be able to continue to stand up to these attacks from Ukraine, as Ukraine continues to get supplied by weapons from the United States and NATO. Anyway, so I do think that that's part of the worry, the concern that's hanging over the market right now. I have to think that a lot of this has to do with the escalation. Because if you think about the interest rate situation, like we already know where the Fed's terminal point is, and that's already kind of like baked into the market. I mean, if you go to that Fed Watch tool at the CME, if you just Google Fed Watch, one word, Fed Watch tool, you know, it shows you, based on where Fed fund futures are trading, it shows you what the market expects as a policy rate going all the way out to November of next year. And that's already there. I mean, that 4.5%, 4.75 rate is already there. I mean, the market already reflects this. So it's not like it's some big surprise. The thing is, every increase now, whether it's the 75 basis points coming up in November, you know, another 75 or 50 basis points, I forget, it might be 50 in December. You know, each one of those rate hikes represent a smaller percentage increase. In other words, when we went from 25 to 50, that was a doubling. When we went to 50 to 1%, that was another doubling, 100% increase, right? Then it was like, then we went from 1 to 150, that was a 50% increase. Then we went from 150 to 225. You know, that was a little bit less. So each time now, even with a 75 basis point, the percentage increase from the prior level is shrinking. So what that is you're having a diminishing negative impact from the interest rates. Okay? I actually graphed it out and I sent it out to my subscribers. I showed that you have a diminishing negative impact from these rate increases. You know, it's trending now down towards zero. In other words, it's trending towards a minimal. Each one becomes less impactful than the one before. You follow me? Like when you went from 25 to 50, that was a 100% increase. When you went from 50 to 1%, that was a 100% increase. Now these increases are slowing down percentage-wise. In other words, the negative impact from the rate hikes, it's being absorbed more easily than when you have these jumps that are like a doubling, okay? However, at the same time, the fiscal impact, in other words, the amount of transfer into the economy, the amount of interest income transfer into the economy, that's going the other way. That's going exponentially higher. So we kind of reached an inflection point here now where the rate hikes are starting to decline in terms of their impact, but the fiscal side of it, the transfers, the interest income transfers into the economy, that's starting to go up. And that is very, very important, because when you reach that inflection point and you start to get into an environment where you're really like riding a growth curve. Now, I mean, look, they just raised third quarter GDP forecast. The last three revisions were upward revisions. We're already up to 2.9% forecast for third quarter GDP. I mean, a month ago, it was 0.3%. Now it's almost 3%. I mean, 3% is a very decent growth rate. That's like average or slightly above average economic growth of the last 40 years. I mean, we basically average like 2.5% a year. The only times we really popped above that is when during the pandemic, when we had massive stimulus. So you're starting to see we reached that inflection point. Yeah, the stocks are still getting, every rally is getting sold because you still have this environment. I think, frankly, I don't even think it has to do with the rate situation anymore, because that's baked in. I think there's a much more serious danger, and that's this escalation in the war. I happen to think that that's the thing, and that's very hard to predict. I mean, the Fed tells you, hey, we're going to go to 475. So, okay, we sit here, we wait, it's in the market, we know where they're going. But I mean, as far as the war is concerned, that thing has sadly unlimited potential to spiral out of control in a really, really bad way. Like if Putin starts to use nukes, even tactical nukes, battlefield nukes, I mean, I think all markets are going to just really, really come unraveled. But that's something like, I'm not a geopolitical analyst. It's almost impossible to predict. I will say this, getting back to the economics. Today it was announced, check this out, Germany is going to do a major fiscal stimulus. I think they're doing something like 100 billion to try to offset their intent is to try to offset the high prices and soaring inflation. France going to do 100 billion. We have the fiscal impact of the interest rate hikes here in the US. So I mean, when you look around, we're seeing again another round of major fiscal stimulus coming together. And, that to me, again, just supports the positive outlook that we're seeing. By the way, all the bank data in the latest week, again, loans up. 27 weeks in a row of expanding lending, loan growth at the fastest rate in 14 years. I mean, this is all very positive. Unfortunately, we have the overhang. The rate situation to me, like I said, that's diminishing in its negative effect. But the war is a concern, I have to say. All right, folks, that's it for today, Monday. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See everybody tomorrow. Bye.